Thanks for checking out another video from NetPicks, and today I want to talk about a trading strategy called the Camelback Trading Strategy. And it was actually designed by a guy named Joe Ross, and it uses both the long-term and the shorter-term trend direction. And frankly, I don't find anything wrong with a trader looking at pretty much the massive trading techniques on the web and finding out if they can make it a viable approach for themselves. Because what I figured out years ago was really there's nothing new in trading. Complex systems, they don't outperform simple approaches to the market. And Jesse Livermore was right, that it's not good to be too curious about all the reasons behind price movements. And a lot of strategies are just tweaks from another. And in the end, can you be profitable trading it? Is it a method that you're comfortable with? And is it simple to explain? So why those three things? Well, can you be profitable trading it? You know that if we gave a group of traders the exact same system, that they're going to get different results. The human side of us, that could be our greatest enemy in trading. And no matter how simple the rules are, too often your human side will step in. So if you're not able to follow the rules that you laid out, you will never find its full potential, if any. So just because you copy a successful system, it doesn't mean that you're going to find any success at all with it. Are you comfortable with it? Well, let's put it this way. Some traders, they swear by using Fibonacci. Well, if you don't believe that there's an order in the universe, you're not going to be able to follow any trading rule that really uses that method. The same goes for moving averages, considered dynamic support and resistance. Now, if you believe that that's just an illusion and what is happening is just the moving average is catching up to smaller price ranges, well, you're probably not going to follow it. If the method's scalping and your temperament is more swing trading, well, you probably won't succeed at scalping. So finding a technique that fits into you, it's paramount to your success. And is it simple to explain? You've probably heard that if you can't explain something to a 5-year-old, it's probably too complicated. Well, if your trading approach requires an hour to explain, you probably have too much room for error. There's probably too many variables to find a trading setup, and there's probably some redundancy in that approach. For me, I try to keep it as simple as it needs to be. Setup plus a trade trigger equals a trade, and just manage it. So let's break down this strategy. Okay, first thing we want to do is find the longer term trend direction. So Joe Ross used a 40-period simple moving average of the highs, as well as a 40-period simple moving average of the lows. Now, can you use larger or smaller periods? Yeah. And all that's really doing is giving you trend direction. And as I talked about earlier, the strategy that you use must fit. So yeah, you can adjust to any length you desire. And he also talked about a shorter term trend direction. And for that, it's the 15-period EMA. So when price is above the 40 SMA channel, we only look for long positions. Price is below it, we look for shorts. And once price enters the channel, there's no trade. So you could actually consider that price inside that channel is a precursor to a potential trend change, which is generally a pretty volatile event. The 15 EMA is a filter. If it's flat, no trades. If the average is sloping down in an uptrend, we stand aside. That means the shorter term trend is against our potential position long. So it will look like a deep pullback on the chart. An upsloping average in a downtrend, probably want to stand aside. So how do you enter a trade? Well, once price picks a direction above the channel or below it, we look at the 15 EMA. So as long as the EMA is favoring the longer term trend direction, we can take a trade. And we look for price to make a new bar low for an uptrend or a new bar high for a downtrend. You simply place a buy stop over the high of the candlestick that made the new low. That's a buy. Sell stop below the low of the candlestick that made the new high. That's a sell. So here is a 30-minute stock chart, and it's got 3 trading signals. Now, Ross used 1 tick above the higher or below the low for the entry. You want to use a small multiple of an ATR. So we're going to use the opposite end of the setup candlestick plus a buffer to place our stop loss. So number 1, we got a valid buy stop above the high of the candle that made a new low. So price pulled back, made a new candle high on this. Number 2, you can see that price spikes into a channel. However, price must be outside the channel for a valid setup. Number 3, we have a new candle high in a trade short. 4, a new candle low in a trade long. Now Ross would split his position into thirds. A third that would scale out to cover your trading costs, 1/3 at some profit target, and 1/3 to ride the trend. And for profit targets, consider using an R multiple, such as 1, 2, or 3 times your initial risk. Trading stops, well, that's going to depend on the volatility of the market. Now, the price channel may be too far away from thrusting price action, which would give back too much of your profits, while the 15 EMA may be too close during low volatile periods. So you got to test this out. You got to find out what you're comfortable with. Now, both can cause you issues that could prompt you to break your trading rules. Let's look at this chart. That's a 4x 4-hour chart. So breaking it down, number 1, we have a valid buy setup, and it's eventually stopped out for a loss. You may have been able to scale out 1/3 to cover your spread. And with the flat and downsloping 15 EMA, we have no other trades. Number 2, that huge momentum candlestick, well, they often lead to snapbacks in price. And price action traders would generally stay away from those types of setups. And number 3, it's a valid short setup. We would not trail up our entry price, as those candlesticks are actually inside our setup candle. At number 4, this invalidates the setup because price has now entered the moving average channel. Number 5, it's a valid setup, but it looks as if that 15 EMA is about to either flatten or point upwards, which may cancel that. Now, understanding price action is no doubt a positive addition to this particular strategy. And you're going to miss trades, but the odds are in favor of snapbacks against your position when price travels too far too fast. Well, trailing stops and profit targets. Well, taking advantage of positive price movement, it's a pretty worthy goal, I would say. And you must determine your trade management rules to do that. So for here, we're just going to use one trade entry for this example, okay? The first example uses the 15 EMA for a trailing stop, and this trade exits for a $183 gain. The second example, same entry, we're going to use the top of the channel. This would run $570 before being stopped out. So why did I put a red X where it appears that that white candle touched the channel? Well, that price of that channel at that point would not be known until after that candle closes. So your stop loss would actually be set at the price for the prior day's moving average price. Okay, and you would not have been taken out. Well, profit targets. There are many ways to set your targets. Okay, and this is going to be a simple multiple of your risk. I'm going to use a 5-period ATR and take that reading, multiply it by 0.02. And you can use any multiple of the ATR you want. So for example, this chart here, the ATR at the setup is $2.22. 0.02 of that is 4 cents, right? So 2% of that. I've added 0.04 cents to the high of the setup candle, which gives me my buffer for the entry price. And the stop is the low of the candlestick minus 0.04, right? Minus 4 cents. I have set the red lines at 2 and 3 times the original risk on the trade. And you can see both are hit if this position would have been filled. So let's wrap it up. The Camelback technique. Well, it's based on the short and long-term trend direction. That gives it a little bit of merit. You got to see price make some type of pullback, which this does. And needing price to resume in your direction through a stop order adds to it a little bit, right? Because it shows momentum in your favor. Now, you may choose to need more of a complex correction, and that would require, for a buy setup, for example, price to make a new candle low, price makes a new candle high, and then you need price to make a new candle low for your setup. Now, this, of course, may have you missing some moves, but the advantage is you're going to get slightly deeper corrections. So in this example here, we'd ignore the first setup with the X. The 2 black arrows show valid setups. The last red bar, that's my preferred setup because not only did it make a new bar low, it made a new swing low. Complex correction. The downside is you can miss trades after one down move, and the potential for a ranging market could be settling in as well. I don't think I'd add any other variables, although a momentum indicator, using that as a hook in your direction, may give you a slightly better edge. And you're also going to have to determine if and when you would consider add-on trades or re-entry rules on stop-outs. So try to get the trades once the price actually crosses the channel lines and before it takes too far off from the channel. Anyways, hope you liked it. Hit subscribe, like the video. Any questions or comments, put them below and I'll get to them, right?